Anyway, this is so important, I have to tell you about it. A lot of people are afraid to stay in the US because they said, especially the high net worth people, I have clients that make a ton of money outside. They don't want to become a taxpayer of the US government without the right to stay. Because if they go to US and they have the visa and all that, they stay over the 183 days, they are subject to US taxes, but no right to stay. They earn the privilege to pay the tax, but no right to stay. Who wants to do that? So most of my clients would dash out of town right away. If they go there once, it's 183 days. If they go there every year they go. Some of my clients buy property there, they want to enjoy it. Then they ask, how long can they stay without triggering that tax reporting? Okay, and I calculate it for them. It is really done like this. I'll give you an example. Example is, if I go to the US, what year is it now? 2019. Your client goes to US, 2019, they stayed 120 days. 120 days is a long time. How many months is that? 4 months, close to that, right? Depends on whether you're 1 day or not, but it counts by the day, not by the month. 100% of that will be counted, so that means 120 days for that year. When that person goes to immigration and get out, the immigration officer may take a look and say, okay, this person has stayed 120 or whatever days. They will look back 2 other years to see how long they stayed. Let's say 2018, this person also comes here to the US, goes to the US and stays 120 days. But how much of that is counted? 1/3. So what is 1/3 of 120? 40.
41
Okay.
days.
40 days. These are the days of the 3 years. Then they may go back 1 more year, it's a 3-year thing. 17, how many days? This person also stayed 120 days.
20 days.
Huh?
20 days.
1/6 of it is 20 days. So how do they add it up? 120 plus 40 plus 20, 160,
80.
huh? 180. 180 days, precisely. 180 days you got by with the skin of your teeth. If you have plane delays and a storm, you can't get out. So I would say that this is kind of a magic number, the 100 to me. As long as you don't stay over 180, 120 days a year, you have no trouble triggering it.
Is it 120 in consecutive, or is it 120 added in the whole calendar year?
Whole calendar year.
So they can go in and out, in
Sure.
total it's 120.
Right, that's my calculation. Interpreting this law. So I want to calm my clients and make them feel comfortable. You don't have to get out of town in 7 days. Sometimes they don't know. People give them different information. I say, I'll show you the regulation. If you stay like this and say, oh, 120 days, I would only stay 110 days and get out. Then they don't have to ever report their money they made outside of the US to the US government, right? Okay, non-resident aliens are considered US resident for income tax purposes if they meet the substantial present test. This is not, the US is not the only country that has it. If you go to UK, same 183-day rule. How many of you don't know that? But they still have to report to the UK government if they overstay their presence. So a few I can't name all the countries, but I know that UK has it, US has it. India too, yeah. So it's not, prejudice against, it's quite a common thing. Capital gain applies regardless of residency status. When you own a property, you sell it, you make money, the sale price less the selling cost and adjusted basis, you're taxed based on about 20%. So the capital gain tax is right now fixed at 20%. 25% is on the recapture of the cost recovery. That's something that you'll learn from my CCIM class. so you would know the after-tax calculations if you do plan to operate in the US. If your sons are going there, I would like, yeah, jump in and take a look at that. That's really worth a while. Okay, 1031 tax deferred exchange. If you guys really like, I'll show you a story of how I make money for my clients based on that. That's too deep for this. It's just using your existing property, you can exchange it to another property if you do everything right. There's a lot of rules. Then you can exchange it to a bigger property or a better property, make more money. And you don't have to pay the capital gain tax. You defer it to another time. Lots of rules on that. Estate tax, that's all you need to know. Foreign owner is subject to federal estate tax on US assets. Substantial present test does not apply, but no exemption in credits availability. What it is that I tell my clients if they're from a foreigner would come and say, I would like to hold the title in my own name without a trust. Sometimes I ask them to, maybe it's best to talk to an attorney and say you hold it under a foreign trust or whatever for estate planning. Because if they die, they have to pay a very high tax as a foreigner. That's the only difference. The local, we have an exemption now of $11.2 million from our estate. So if my estate, if you're married, you'd have double that. So 20-something million dollars today is is deferred, is not tax, is tax exempt from the estate. It used to be $4 to $5 million. Because of this crazy president, I don't know how he made it happen. It's now 11.2. That's